Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every single day. Well, today we're talking about Aptus Value Housing Finance Company, and as the name suggests, it is essentially into housing finance. Well, this is an NBFC. It's a relatively smaller NBFC, at least in terms of market capitalization with respect to several others, but it does seem like it has done its part in terms of growth of late. That said, let's take a look at how things have panned out and what the company in fact does. So, of course, it offers loans for home construction, home purchase, renovations, as well as home extensions, and it's focused on self-employed, low and middle income families, primarily from semi-urban areas and rural areas. And that perhaps at this point in time, it does look like it has its strategy in place, and what kind of markets it wants to target and what kind of clientele it's looking for, what kind of borrowers it is looking to focus and target as well. Now, the average ticket size for this particular company is about 10 lakhs. So the sum itself is also not significantly large, and a lot of the targets here will likely have a ticket size of less than just 10 lakh rupees. But in terms of product mix, how does that pan out? Now, at the end of the third quarter of this financial year, if you consider how things were in terms of your loan, well, 61% of your home loans, rather 61% of your revenues, or rather your loan mix was home loans, and that was followed by another 21%, which is small business loans, and quasi-home loans comprise about 14%. So that's as far as your split's concerned. What geographies are they in? Well, they are in 6 states currently, in one union territory, and they have a little less than 300 branches. 298 to be precise is where the number of branches is, and it has seen a significant shift in the number of customers it has catered to since FY20. In the last, well, a little less than 5 years, it has seen its customers move from a little less than 44,000 all the way to well over 1,52,000 customers. So, like I said, it has seen a lot of growth, even in terms of your branches, which has gone from 175 back in the end of FY20 all the way to 298 precisely at the end of the 9 months ended, FY25. So this is as far as the company is concerned. We do know that Aptus Value is in a space which is there's a lot of competition here. Now, this is a 15,000 crore market capitalization company. So, and there are plenty out there in terms of competition. It's something that we're going to address as well a little later on in the show. But for now, this is what the company does, and it's to give you an idea about how things have panned out. Now, as we always do, we take a look at the fundamentals of all these companies and see how things have, in fact, panned out for the company in terms of your income statement, your balance sheet, your operational metrics, as well as asset quality. These are some of the most important aspects as far as an NBFC is concerned, an NBFC catering to housing finance is concerned. But moving on, we look beyond and we take a look at shareholding as well, valuations, street credentials, as well as street coverage too, to give you a better idea of how the company has done and has panned out. Well, in order to do that, as usual, I am joined by Harsh, who's also going to help us shed more light into what the company has been doing of late. So, Harsh, good morning and thanks for joining in. I reckon that income statement, as usual, would be the good place to start off with.
Yeah, absolutely, Agam. Largely when you're looking at the kind of trajectory that the has taken, it's roughly a 30% kind of CAGR that they've done over the last 5 years. And I'm just trying to zoom out a little bit here, just for better context. And net interest income growth also equally healthy. We've seen a 28% growth both on NII as well as profit after tax when I'm looking at the 2-year CAGR of this company, or near 3-year CAGR as well. So healthily placed on that count where the growth numbers are concerned. The trajectory looks good. A little bit on the OPEX front, you've seen OPEX grow at around 25% despite top line growing at 30-odd%. And therefore, you're seeing a little bit of OPEX play also starting to play out on that P&L number, on the profitability metric. So just those couple of things to be kept in mind. How much will that ramp up happen, etc., will also be interesting to understand. But yeah, that's how it is.
Okay, so well, pretty healthy income statement from what we see and what we can make out. So it's certainly a thumbs up there. I'll quickly take you through the balance sheet, and perhaps Harsh can give us a little bit more color on the balance sheet as well. But, well, they have seen their AUM grow. This is, of course, an expected lines because back in FY22, they had an AUM of around, well, you know, little less than 5,200 crores. Has grown to 10,266 crores to be precise right now. In terms of their borrowing as well, moving in tandem from 2,700 crores all the way to little less than 6,500 crores. And this particular number is perhaps something what Harsh can shed light on, also give us the full formula. So yeah, what are you going to tell us about this particular ratio?
It's the capital and risk-weighted assets ratio, which generally typically determines how well capitalized the company is. Of course, all NBFCs and banks need to have adequate capitalization, and generally that's between the range of around 15 to 20% and 20 to 25% for certain fast-growing NBFCs. This one is sitting at 65% and therefore very well capitalized, at least in the medium term. It's of course growing at a healthy clip as well, but that capital ratio of 65% just kind of signifies that there is just adequate room available for it to grow.
Right. So no concerns about the fact that it has moved from 81% to 65% because other than that, ratios in general are sub 25%.
That's correct.
Okay, so there you have it, which is why we're giving this the balance sheet, you know, a thumbs up as well. But what about the other key operating metrics, Harsh? What can you tell us there?
Well, yeah. So when you're looking at your margin number, again, some of these numbers may well change because it's so well capitalized, and therefore there's so much scope for the borrowing number to go up and interest expense also to go up. If both of those numbers actually go up, you'll see margins come off, and therefore the better way to look at it is spreads. What's happened with spreads? And let's zoom out also a little bit. From 9.2% spreads have come down to 8.7%, but also it's an environment where the borrowing rate has gone up substantially for NBFCs. From FY22, we've seen the repo go up quite sharply, 2% plus, and therefore some of that also reflecting on your spread number. But nonetheless, they've been able to maintain their spreads. Of course, a slight bit of dilution, but they've been able to maintain it. Question is, can they continue to maintain it? And now, with the repo rate cut coming into play, what do you expect in terms of spread? So that's one number I'll be very keen to know. The other piece is with the ROA. The ROA has come off for 9-month FY25, and therefore the ROA trend, how does that go, is something that, again, we would be keen to know. But a near 8% ROA for a company largely lending to the housing or with housing as the collateral doesn't look bad at all, right? Your OPEX to assets also have remained healthy between the 2.5 to 2.7% range. So that's how it's kind of stacking up. You look at borrowing costs going up, that's largely impacting spreads. That's how it is.
Okay, so that's as far as your operating metrics are concerned. Again, this is a tick mark is there as well. We'll talk about asset quality. Now, what's happened here is that there has been a little bit of an up move in terms of your gross NPA ratios. Back in FY22, it stood at around 1.19. It's currently standing at around 1.28. Now, let's not get this wrong. This certainly is an increase. That said, you know, these numbers are relatively lower at this point in time. In general, if you compare it to several of the other NBFCs. So while they may be increasing, the numbers are not terrible. It's the same for the net NPA ratios as well. Back in FY22, that stood at around 0.88, you know, and it's moved up to around 0.96. Do remember that when a company is on a growth path, what usually happens is that as you take on more of the business, oftentimes you do see a little bit of an up move in terms of these numbers as well. It does not mean that you know the asset quality is at a concern at this point in time because of the absolute numbers are a tad low. But Harsh, you want to come in and add something here?
Yeah, it's interesting, right, Agam, because what you're seeing in terms of that net NPA ratio, and when I'm looking at the 5-year trend, Over the last 5 years, this is probably the point where asset quality is sitting at its worst point in the last 5 years.
Yeah.
So whether that's a concern, and why is that so? And the other piece that I'd be worried about, even in terms of asset quality, is 40% of its book comes from a single state, which is Andhra.
Right.
And therefore, that may also be a risk and a concern.
Right.
They're going into Odisha, they're going into Maharashtra. Those are two states they are venturing into. But those are also states that they will know less about in terms of customer cohort.
Right.
And I include this as part of asset quality only from a perspective that there could be these emerging risks come up when it comes to your asset quality. Of course, the little bit of slippage that we've seen, or the little bit of slip that we've seen on asset quality, probably sitting at 5-year lows in terms of quality, is the other concern. And hence we give it a neutral, because not entirely comfortable with the way that's gone by.
Fair enough, fair enough. So that's, talking about asset quality. If you, Harsh, want to talk about shareholding as well.
Yes.
An interesting promoter holding here.
Yeah, absolutely. So, so we've got 53% promoter holding currently, but out of that 53%, nearly 29% sits with Westbridge alone. That's of course, it's an LLC, but it will eventually exit at some point. 7% already they've exited in the quarter ended June 2024, after which they've diluted maybe another % or so, but not significantly. So over the last maybe 3 or 4 quarters, if I look at it, the dilution has been roughly 6+%. And that is also reflecting on the number on your screen, the % of dilution over the last quarter or so. But the 6 to 7% otherwise is a large dilution. And Westbridge held around 34.5% in the company at the start of the financial year. And therefore, it's a large chunk in terms of the overall equity of the company. Outside of that, you have, of course, one of the promoters holding around 19%, which is okay. Wouldn't be too worried about that. But moreover, this little bit of overhang, Agam, and we've seen this, it could well be that the overhang goes away, but it could well be that it remains as well.
Right. No, absolutely. Point taken. And, at the moment, besides, of course, that particular, private equity holding stake, even if you look beyond in terms of FIs and DIIs, for the size at which it is, it has reasonable amount of holding from institutions, which gives you a little bit more of a backup. But that overhang will remain. It remains to be seen as to when Westbridge will look to, shed more weight. And when it does, what kind of institutions will come in and will buy into this particular company. So neutral rating on that one. It will also be a neutral rating on valuations, and I'll take you through that quite quickly as well. If you consider the 1-year forward price to book, and this is as per the Bloomberg consensus, this gives you an price to book of around 3 times. And this is more expensive than Aadhar Housing Finance, which is at around 2.5 times, and PNB Housing, which is at around 1.2 times. It's understandable that I think that the third name out there should be Punjab National, PNB Housing, which comes in at around 1.2 times, which will also need to be corrected. It's understandable that PNB Housing Finance is at around 1.2 times, but Aadhar, which is considered to be a slightly higher growth path, can be compared here, not taking anything away from Aptus, because as you can see, and as you've already spoken about, it is on a significant growth path to, in fact, showing a lot in terms of what it has done, which is why I reckon that markets would probably want to ascribe a higher valuation to something like an Aptus or Aadhar Housing. But given the fact that it is the most expensive of these 3 at the moment right now, it's going to be a neutral rating here as well. Street coverage, Harsha, we have plenty out here as well.
Well, yeah, very healthy in terms of street coverage. 16 analysts cover it, and a 30% upside from here that the average analyst estimate seems to suggest, 394 being the target price, all of which indicates a buy on the stock for sure, and therefore a thumbs up on this one very clearly. 3 things. 1, 16 analysts cover it, 13 have a buy, and 30% average upside.
Okay, and Well, I'll also tell you about how the stock has panned out. So firstly, in terms of the listing back in 2021, from those levels, the stock is currently lower. So that's not exactly encouraging. On a 1-month basis, it has come down 5%. Last 6 months, correction has been, again, 5%. And the last 12 months, the stock has, come off by around 11.5%. Look, we must realize and understand that, in tandem with something like a mid-cap or a small-cap index, it has outperformed to a certain extent. But overall, the gains have not been satisfactory. In fact, if you consider the 3-year performance, it has moved up only 21% over the course of the last 3 years. Then this is as the markets moved from strength to strength over the last 3 years. So the share price has not moved significantly. Perhaps this is because of valuations, because we do see that growth pan out for the particular company. So some of these factors are playing in favor of the company, but that the valuations have not, in fact, have provided some sort of a headwind for the share price here. But let's take this conversation forward. We are now in conversation with Balaji P, the Managing Director at Aptus Value Housing Finance. Welcome to the show and thank you for joining in. My first question then comes down to your view and what you anticipate with respect to growth, because we've seen very strong growth over the last 2 to 3 years. Can we expect growth to come through at the same clip, even as you expand to newer geographies here?
Thanks for having me on the show. Good morning, all. Just to talk about the growth. What is happening is, if you look at the overall market opportunity that is available in the affordable housing, one is the mortgage penetration in the country itself is very low at around 11% of the GDP. And also the housing shortage is more acute in the areas where we operate, basically the tier 2, tier 3 and tier 4 locations. So this makes us very confident of having to grow at around 30% for the next 3-4 years. And what is happening is the support that is being given by the government in terms of PMAY and the tax benefits that are available both for the company and also to the customers and the housing loan customers. This makes us really confident that we are having a huge runway for growth. And despite this market size can support more competition as well. Plus the healthy growth for Aptus Housing, which we are projecting around 28 to 30% in the next 3-4 years. So that is what is making us really confident about this. Yeah.
Point taken. So this is Harsh also joining in the conversation. While I take the point that growth is extremely strong, also want to understand context from you. You're growing solidly within 2 key geographies. One is Tamil Nadu, one is Andhra, and maybe not geographies, but states. You plan to grow Odisha, you plan to grow Maharashtra in a bigger fashion now. Moving into a different geography, would that impact your asset quality metrics? And what gives you the confidence, if not, that it will not impact your asset quality?
Sure. Good question, Harsh. See, if you look at it, our strategy for growth is this way. See, I select a particular state and go deep into it. So if you look at it, every 50, 60 kilometers in a particular state, I'll have a branch. So this we have done it in the states of Tamil Nadu and Andhra Pradesh, which is contributing to the growth. We'll be doing this in the states of Telangana and Karnataka as well. And also the same thing will be replicated in Odisha and Maharashtra. See, if you look at the genesis of this company, first, this company has been there for 15 years. First 5 years, we were mostly in Tamil Nadu only. So we ventured into other states of Andhra Pradesh and Telangana, where we were able to get this growth and still maintain the same asset quality. So we are very confident that even in Odisha and Maharashtra, this credit quality will be maintained, because the primary philosophy of this company is a credit driven company rather than a growth driven company. For us, the quality of book is more important than the growth. So with the result, we are very confident that we'll be able to do the same thing. We have replicated from Tamil Nadu to Andhra Pradesh, Telangana and Karnataka, and we'll be replicating this in the new states of Odisha and Maharashtra also.
So, Balaji, when it comes to quality, as you mentioned that there's going to be of prime importance, considering we are looking at a slight edging up in terms of your net and gross NPA ratios, do you think that we're likely to see a stability around here, or do you think that as business grows, we could see a little bit more of an inch up in these numbers as well?
It might not be so. If you look at it, we closed last financial year with a GNPA of 1.07%, and this has increased to 1.28% as of December. But December quarter was slightly affected because what happened was some cyclical factors affected the industry. In the southern part, normally in November the floods come in, and in October there were some holidays which was bunched up because of the festivities. So that had slight impact on the collection efficiency. But we are seeing great traction in this quarter. With the result, there will be a good improvement in the asset quality and also the GNPA, which might be lesser than what we reported in December. So we are not seeing that kind of a problem in any of the states in terms of asset quality.
Okay. Sir, the other key overhang, and I know maybe you're not completely in control of this one, but I'm sure you're having conversations with Westbridge. They've diluted around 7% in this financial year. And to that extent, it will continue to be one of the overhangs on the stock price. And that's clearly reflecting as well. Is it one, a concern for you as management as to who comes in as the other shareholder, because it's a substantial chunk? And second, is there any visibility of how quickly they leave and how quickly they exit? Is there any visibility of that?
Right now, if you look at Westbridge's investment, they came into the company as a private equity investor sometime in 2014, and they have been supporting this company till the IPO time, where they were holding almost 47-48%, and at the time of IPO they sold around 10%. And as you rightly told in your commentary, around May June of this financial year they sold around 6-7%. So after that, Westbridge, I don't have any information on what is their plan or when they are going to sell, and if they sell, to whom they will be selling. So as of now, I don't have that information. And definitely, as you rightly told, this would have played as a overhang, but I'm not able to. I don't think I can control it sitting in the company.
Okay, understood. So, what about sustainability with regard to both spreads as well as how do you see margins evolve? Because you'll take on more debt as you go by, you're very well capitalized. And therefore, what do you give as guidance for both margins? How do you view it? And spreads, are they sustainable at this kind of near 9% kind of level?
Definitely, we feel that we'll be able to do this because if you look at our yields, our consolidated yield is around 17.37%. This is not because we are charging high rates of interest. It is basically the product mix. On a consolidated basis, we have around 62% as housing loans. The other thing being the non-housing loans. Again, that is getting classified into some of quasi-home loans, and the other one is the small business loans. And because of this product mix and the interest rates we charge, it is at around 17.37, and our cost of funds is at 8.68 as of now. So that is resulting in an 8.7% spread. Going forward, if you look at my total borrowings, around 53% of my borrowings is variable, and of that 53%, 23% is linked to external benchmark rates. So obviously, this 0.25% of that 23% rate of interest that can come down maybe by 0.05% immediately. And also for the MCLR linked borrowings, it might take another 6 months to come to get this rate cut benefit. So with the result, the spreads are likely to widen and it is likely to increase. And if you look at but what will happen is, as you rightly told, there will be no equity infusion into the company, and all the growth which we are projecting is going to be funded out of borrowings. So with the result, the leverage will go up. Because of that, the absolute cost of the interest cost will go up. Actually, the debit in the P&L will go up. So to that extent, the ROA which is at around 7.7% as of now, another 2 years down the line, it can come to around 6.8 or so. But ROE, which is at around 18.5 as of now, will go up beyond 20%. So this
Okay.
is the plan with which we'll be doing. Yeah.
Right. Right. Well, Balaji, we leave it at that. Thank you so much for joining us and taking us through your views on, well, the business that we can expect to come through over the course of the next few years. We wish you the best.
Thank you. Thank you, Harsh. Bye.
Well, there you have it. Well, before we conclude, a very quick look at the overall ratings that we have given the company at the moment based on its fundamentals. So it's very strong income statement, balance sheet, and operational metrics. Moving on to the next set. Well, overall, not a lot to complain about, which is why we give you a total rating of around 5.5 out of 8. Well, on that note, we're completely out of time on this edition of KYC. Stay tuned in, and we will be back in just a bit.